Hey traders, and welcome to another episode of The Smart Risk. The ultimate aim for any trader or investor is to achieve consistent profitability in the markets. A successful trading strategy is a guide that ensures you will stay on track on your journey to your desired destination, and it is crucial for surviving the financial market's intense competition. In this episode, we're going to show you one of the advanced ICT trading strategies that will give you the edge and insight that you need to stay ahead of the market. And also, this strategy will guide how you will enter and exit trades in the markets in a manner that enhances profitability and reduces risk exposure. So traders, if that's something you're interested in, please give this video a thumbs up to show your support, and subscribe to our channel if you are new. See you after intro. Welcome back, traders. Let's get started. So, before we get into the details of the strategy, you need to know the exact definition and application of these topics. We have fully explained most of them in the previous episodes, except the ABC pattern. If you are new to our channel, to fully understand these important topics, go through our channel and watch our previous videos, which are linked in the description of this video. But let us have a brief explanation of each one in this video. So let's start with the ABC pattern. So traders, what is an ABC pattern? The ABC pattern is created by three major waves of price. In the bullish scenario, the ABC pattern contains a rally wave upward. Then we have a bearish retracement to the downside. And finally, we have the C wave to the upside. The C wave is a liquidity sweep that sweeps out the liquidity accumulated above the high. The B wave would contain a couple of bearish candles and doesn't have to be a significant downward wave. So this is the sort of pattern you should be looking for in a 15-minute time frame according to the rules of our strategy. The key point is that a bearish ABC pattern is only valid when the C wave sweeps the liquidity above the highest point of the A wave, with only one candle or wick, and a second candle or a wick should not form or close upper than the first candle's body or wick. We want to see price immediately change its direction to the opposite way and get back into the range below the high after sweeping liquidity. And also, a bullish ABC pattern is only valid when the C wave sweeps the liquidity below the lowest point of the A wave, with only one candle or wick, and a second candle or a wick should not form or close lower than the first candle's body or wick. So let's move on to the next topic, market structure shift. Imagine a trending market with a series of higher highs and higher lows. In this case, each of the highs and lows is the market structure level, and the most recent higher high and higher low is the one we monitor. Breaking the last higher high to the upward shows that price tends to go the upside, which we consider as a break of structure. In contrast, if price breaks the higher low to the downside, it shows that price wants to change its primary direction, which we consider a change of character. The key point is that a break of structure is valid, even if a shadow breaks above the previous structure level. But for a change of character, we definitely need price to break and close a candle below the previous market structure level. Imagine we have a valid ABC pattern. That price swept the liquidity above its high by the C wave with one rejection candle, and then reversed to the downside. The next step is waiting for a change of character to appear. So for that, if we zoom into the lower time frame, for example the 1-minute time frame, we would see a structure like this. As I mentioned before, we should wait for a change of character. So, what are the features of a valid change of character in the ABC pattern? According to our strategy's rules, a change of character is valid for us. When price breaks the structure which is created by the wave, that swept the liquidity of the ABC pattern. As you can see here, in this scenario, price swept the liquidity by this tiny wave. So if price breaks and close a candle below this structure, then we have a valid change of character here. However, suppose price created a structure like this on the lower time frame. In that case, this change of character is not valid because this structure, which is broken, does not belong to the wave that has swept the liquidity and was created after liquidity sweeping. So to have a valid change of character, price must break this structure, which is made before a liquidity sweep movement. Let's see another possible scenario. Suppose the price touches this high and gets reversed from it without sweeping liquidity above the high. And in the following, price pushes upside and makes a higher high, which sweeps the liquidity. In this case, we should wait for the first movement structure to be broken to have a valid change of character. Please note that we did not consider the upper structure as the market structure shift. So let's get started on the following subject, fair value gaps. What is the fair value gap meaning, and how can we identify it? Fair value gaps are zones created by inefficiency in the market, and usually occur in a specific zone, where there is less trading activity seen, and price only has the one-directional movement. Fair value gaps are a very useful concept in price action trading, and they represent zones where a lot of orders were injected for creating inefficiency in the market. FVGs represent new trading opportunities, especially when coupled with order blocks because these zones are excellent points of interest. Fair value gaps can become a magnet for price in the future to fill the inefficiency as there are many resting orders. Also, we can use them as targets for our entries. So, let's see how we should identify a fair value gap. Fair value gaps are formed inside a three-candle sequence and are frequently shown on the chart as a large candle, in which the upper and lower wicks of its neighbor candles do not fully overlap its body. Hence, the fair value gap zone is the area that fills the space between the wicks, which is drawn on the body of a candle. Here, during the price move down, a fair value gap or liquidity gap is created by the lack of buying pressure that overlaps that part of the move to the downside. The key to identifying fair value gaps is that the gap can only be calculated by taking the impulse up or impulse down the candle, as well as the candles on either side of it. Everything else does not contribute toward that gap. These packets of liquidity are important and can act as strong entries in the market. For example, here price has the tendency to move downward, and it wants to sweep the potential liquidity zones above it. Thus, these areas are great areas where the price may rise and after testing, continues to bearish with even more strength. So, traders, we already have discussed the basics of our strategy. Let's get into the detail of the strategy and see what steps and rules we need to follow. Our strategy has 4 major steps to follow. Step 1. We need to spot a valid ABC pattern in the 15-minute time frame. Step 2. We should zoom into the 1-minute time frame and look for a valid change of character. Step 3. We need to detect fair value gaps close to the current price of the market. Step 4. We should set up our buy or sell orders in the entry points on the 1-minute time frame and wait for price to activate them. Hence, we obtained a general outline of how to apply this strategy. But before trying these steps into the price chart, let's have a brief overview of the entry points and how to set up your stop loss and take profit margins in this trading strategy. So, let's start by explaining the entry method. As you can see, we have a valid change of character in the 1-minute time frame. So in the next step, we should spot fair value gaps near the current price. Imagine we have spotted 3 fair value gaps near the price. So the question we need to ask ourselves is, which would give us a better opportunity to trade? The key point is that the highest fair value gap, which is the closest fair value to the liquidity sweep area, has a higher priority for us compared to the others. We may obviously miss some trade opportunities by setting our order in the first fair value gap, but it provides a high rate of reward to risk. So here, we have a valid fair value gap. So in the next step, we need to put our sell limit order at the lowest point of the fair value gap. Then we should set our take profit margin at the lowest point of the B wave, and also the stop loss must be set a couple of pip above the fair value gap's first candle. And already you can close half of your position when price reaches your 1 to 2 target. This way, even price rises and hits your stop loss, you are still at break-even. In addition, you can keep track of your profits, meaning that, in the bearish scenario, every time price makes a lower high, you should move your stop loss a couple of pips above the highest point of the lower high. So, we already have discussed our strategy's main rules, basics, and entry and exit points. So let's put them together and use them in real trade examples. So we have the euro-dollar pair 15-minute time frame on our chart. This is the A wave. Then we have the B wave and also we have the C wave. Once we have identified the ABC pattern, then we should see if this ABC pattern is valid or not. For that, we draw a line from the highest point of the A wave to the current price. As I have mentioned before, a bullish ABC pattern is only valid when the C wave sweeps the liquidity below the lowest point of the A wave, with only one candle or wick, and a second candle, or a wick, should not close or form lower than the first candle's body or wick. So here, as you can see, Price has swept the liquidity by this candle's wick. And also the second bullish candle is formed upper than the first candle and closed above the line. So we can say that our ABC pattern is valid. There is a very important point that we need to keep in mind. Once the first candle is closed, we should zoom into the 1-minute time frame and wait for a valid change of character to appear. But at the same time, we must have eyes on the second candle's body or wick, which is created in the 15-minute time frame to see that is not closed or formed lower than the first candle's body or wick. If the second candle's body or wick closes or forms lower than the first candle, then our setup is invalid and we will have no trade. So guys, we have identified the valid ABC pattern here. So in the next step, we are going to zoom into the 1-minute time frame. So as you can see, we have got the A wave, the B wave, and the C wave. Let's get into the current price area. Next, we should wait for the market structure shift or change of character to appear. So guys, as you can see, we have this structure right here, which is broken by price. Do you consider this a market structure shift? The answer is no, because price has touched the line drawn from the lowest point of the A wave, reversed, and then created this structure. But if you look upper, you can easily spot this structure, which was created before price went down to sweep out the liquidity. So, as we have identified a valid market structure shift or change of character, in the next step, we should look for the lowest fair value gap near the current price. As you can see, we have a fair value gap right here. So we set up our entry order at the highest zone of the fair value gap. And also we put our stop loss a couple of pip below the fair value gap's first candle. And for putting our take profit, we should zoom into the 15-minute time frame and put our take profit margin at the highest point of the B wave, as I explained before. You can see that we placed our order and now we should wait for price to activate our buy order. As you can see, our order is activated very soon. Now, let's see what is going to happen. As you can see, price rose, and finally, our take profit is hit by the price, and the reward to risk ratio of the trade is almost 6. So let's see another trading example. So here, we have the Europond 15-minute time frame on our chart. We can easily spot the A wave, and we have the B wave. Then we have the C wave going on. So next, we draw a line from the highest point of the A wave. We want to see that price breaks the line through the upside, sweep the liquidity above the A wave with a single candle or a wick above the line, and then we want to see price drop below the line. As you can see, price swept the liquidity by this wick and then closed below the line. Now that we have a valid ABC pattern, in the next step, we are going to zoom into the 1-minute time frame and wait for a market structure shift to appear. As you can see, we have this market structure here, created before the market liquidity sweep, and it belongs to the wave which has swept the liquidity. Now, as you can see, price breaks and closes below the structure, so we have a valid change of character or market structure shift. As the price made a market structure shift, we are now looking for the highest fair value gap above the change of character level to put our sell order. As you can see, this is the highest fair value gap, so we are going to highlight it. Next, I'm going to set my sell order at the lowest point of the fair value gap. And I want to place my stop loss a couple of pip above the first candle of the fair value gap. And for placing the take profit, I'm going to zoom into the 15-minute time frame and put the take profit margin at the lowest point of the B wave at around 0.882. Now that we have executed our sell limit, let's see what will happen. As you can see, price pushed upside and activated our sell order. But there is an essential point that you should never forget. If price without triggering your buy or sell order reaches the B wave's highest or lowest point, I mean in both bearish and bullish scenarios, then you should cancel your buy or sell orders because our trading setup becomes invalid in this condition. As you can see, price rapidly pushed the downside and finally hit our take profit around 0.882. Before using any trading strategies in your real account, you should backtest those strategies almost for 100 trades in at least 1 year. That's it, traders. I hope this video was helpful to you. If you enjoyed the video and want us to keep making more videos week after week, Please click the subscribe button and turn on the notifications bell in the comments section. Let us know your opinions and tell us what topics you want us to cover, and we'll work our best to create more videos for you. So, thanks for watching, and we'll see you in the next episode.